Hello everyone, welcome. It's great to meet all of you. I'm Ferry Kasitohang. I'm a Master of Business Administration student at IPMI International Business School. Today, we'll be exploring the fascinating world of corporate finance, where strategic decision shapes the future of business and drive the economic growth. So, what is corporate finance? Corporate finance is the area of finance that deals with the financial decision of businesses. It aims to maximize the shareholder value through long-term and short-term financial planning and implementation. So essentially, it is about how companies manage their financial resources. Corporate finance aims to strategic planning, which support business plan to the future by making informed decisions about investment, operation, and growth. And the second is to aim risk management, which effectively identifying, assessing, and mitigating financial risk. And the third, it is the ultimate goal of corporate finance, which is value creation. It maximizes shareholders' value by optimizing the company's financial performance. So what's the objective of the corporate finance? Corporate finance is essential for decision-making, strategic planning, ensuring long-term financial health, which objective to maximize our shareholder value and optimizing capital structure and ensuring liquidity. So this diagram shows us the key roles of the corporate finance, which including financial statement, financial analysis, working capital management, financing and defense, risk management, capital budgeting, capital structure, corporate governance, financial market and instruments, merger and acquisition, and internal corporate finance. From these key roles of corporate finance, I would like to highlight two key roles of this corporate finance mapping, which are first is capital structure and the second is corporate governance. So let's move forward to the capital structure. What is capital structure? Capital structure refers to the mix of debt and equity that a company uses to finance its operation and growth. It is a very crucial aspect of a company's financial strategy because it affects the firm's risk, return, and value. So what's the key component of the capital structure? The first key is debt financing. Debt financing explain about borrowing funds from loans, bonds, and other financial instruments, which debt must be repaid over time, even often with interest. The advantage of debt financing is that interest payments are tax deductible, can increase return on equity due to leverage. On the other hand, the disadvantages is it is obligatory payments, which increase financial risk, potential for insolvency if cash flows are inadequate. And the second key component is equity financing. Equity financing is raising funds by issuing shares of stock. Equity does not need to be repaid, but it dilutes ownership. What's the advantages? The advantage is there is no obligation to repay, no interest payments, can provide large amount of capital. On the other hand, the advantages is it is a dilution of ownership. Dividends are not tax deductible. It is potential for conflict among shareholders. So let's move to the concept of the capital structures. There are four concepts of these capital structures. First is cost of capital. The cost of capital is the return that investors expect from their investment in the company. It includes the cost of debt and the cost of equity. The terms is like weighted average cost of capital, WACC. It is the average rate of return a company is expected to pay its security holders to finance its assets. It is weighted based on the proportion of debt and equity in the capital structure. And the second concept is leverage. It is the use of debt to amplify potential returns. High leverage can increase returns but also increases the risk of financial distress. Financial leverage is the ratio of debt to equity or debt to total capital. And the operating leverage is a proportion of fixed costs in company's cost structure. High operating leverage means a small change in sales can lead to a large change in operating income. And the third concept is what we call optimal capital structure. It is a mix of debt and equity, which minimizes the company's cost of capital and maximizes its value. Determining the optimal capital structure involves balancing the benefits and the risk of debt and equity financing. And the last concept of capital structure is pecking order theory. This theory proposes that companies prioritize their sources of financing based on the principle of least effort or resistance. Prioritize to use internal financing first, then debt, and issue equity as a last resort. So, how do we manage a capital structure? Here are some steps that we should implement to manage a good capital structures. So first, you have to assess current capital structure by reviewing the proportion of debt and equity, calculating key financial ratios such as debt to equity ratio, interest coverage ratio, and leverage ratio. The second is you have to evaluate business risk. First, analyze the company operating risk and stability of the cash flow. And companies with higher business risk may prefer lower levels of debt to avoid financial stress. The third step is you have to determine optimal capital structures by aiming to find a mix of debt and equity that minimizes the company's weighted average cost of capital. And use models like the trade-off theory and pecking order theory to inform the decision. And the fourth step is you have to consider growth opportunities by ensuring that the capital structure support long-term growth plans. And high-growth companies may prioritize equity to avoid the burden of fixed interest payment. And next step is you have to analyze market condition. First, take into account current interest rates and stock market condition. Then, favor debt where interest rates are low and equity when the market valuation is high. And the sixth step is you have to make sure for the tax consideration. First, consider tax benefit of debt since interest payments are tax deductible. And second is you have to balance the tax shield against the risk of financial distress. Next is you have to maintain financial flexibility. Keep enough the financial flexibility to raise capital quickly if needed and avoid high levels of debt that can limit the company's ability to take on new opportunities. And the last is you have to monitor and adjust regularly and continuously review the capital structure to ensure it remains aligned with the business goals. And then adjust the mix of debt and equity in response to changes in business environment, market condition, and company strategy. So in conclusion, understanding and managing capital structure is essential for a company's financial health and growth. It involves finding the right balance between debt and equity to optimize the cost of capital, manage the risk, and maximize the shareholders' value. For the next key roles about the corporate finance is a good corporate governance. So what is a good corporate governance? It is a system of rules, practices, processes by which a company is directed and controlled, balances the interests of various stakeholders such as shareholders, management, consumers, suppliers, financiers, government, and community. What's the key elements to implement a good corporate governance? First, board of directors. A well-functioning, diverse, and independent board is very, very crucial. They should oversee the management and ensure the company operates in the best interest of all stakeholders. And the second is transparency. Companies should provide timely, accurate, and comprehensive information about their operation, performance, and financial position. And next is accountability. Management and the board are accountable to shareholders and must act in their best interest, ensuring responsible decision-making and ethical behavior. The next key element is fairness. All stakeholders should be treated equitably. Shareholders should have the opportunity to participate in key decisions and be fairly informed about the company's activities. And next is responsibility. Companies should comply with all laws and ethical standards, considering the social, environmental, economic impact of their operation. And then you have to make sure to implement the risk management. Effective processes should be in place to identify, assess, and manage the risk that could impact the company's objective. And next is internal controls. A robust internal controls and audit function are very essential to ensure accuracy and integrity in financial reporting and compliance with law and regulation. So how do we implement a good corporate governance? First, you have to establish a competent board of directors. The second, define clear roles and responsibility between the stakeholders and the board of management. And the third, you have to promote transparency and disclosure. Next, you have to implement strong internal controls and risk management. Next, you have to monitor accountability and performance through all the management team. And the sixth is you have to foster ethical behavior and compliance. Next, you have to engage with the stakeholders. And last, you have to do continuously improvements such as trainings and etc. So in conclusion, good corporate governance leads to a better decision making, increased accountability, improved performance, and ultimately enhanced investor confidence and long-term success for the company. So by implementing these steps, company can establish a strong governance framework that enhances trust, improve performance, and long-term sustainability. So, in summary, corporate finance is the backbone of any businesses, guiding crucial decisions that affects the company's growth, stability, and profitability. Throughout this presentation, we have delved into essential components of managing a company's financial resources, including strategic planning, risk management, and value creation. Remember, the principles of corporate finance are fundamentals to achieving long-term financial health and sustainable growth for any businesses. So by understanding and applying this concept, you can help steer your organization towards greater success. Thank you for joining me on this introduction to corporate finance. If you find this presentation insightful and valuable, please like and subscribe. Stay tuned for more informative session. See you next time. Thank you.